Most companies that earn high returns today won't earn them in 10 years. Historically, fewer than 1 in 5 maintain that edge for a full decade. The data shows the difference comes down to one structural advantage, the economic moat. In the next 8 minutes, you'll learn what a moat actually is, how to test for one, and we'll run that test on a real company. In 2026, competition is moving faster than ever. New AI models launch monthly, and pricing pressure has reached industries that once felt untouchable. Based on the numbers, companies without a structural edge are seeing margins compress within quarters, not years. Take cloud computing as an example. Amazon Web Services still holds a leading share of the cloud infrastructure market. Why? Switching providers means rebuilding infrastructure, retraining teams, and accepting downtime risk. That switching cost is a moat. It's a key reason. AWS can sustain pricing power even as competitors undercut on price. Understanding moats helps you separate companies built to last from those riding a temporary wave. A moat is a structural advantage that protects a company's profits from competitors. The term comes from Warren Buffett, who compared durable businesses to castles surrounded by water. Historically, moats fall into 4 broad categories. Cost advantages, producing goods or services more cheaply than rivals. Switching costs, leaving the product or service is expensive or disruptive. Network effects, the product becomes more valuable as more people use it. Intangible assets, patents, licenses, or brand strength that competitors cannot easily copy. A real moat shows up in the numbers as consistent returns above the cost of capital. Why does this matter for an investor? The data shows companies with durable moats compound capital more reliably over long periods. Without a moat, competitors copy what works and margins fall. Pricing power disappears. A company can grow revenue for years and still destroy value if competition erodes margins faster than growth adds to. Profit moats don't guarantee good returns at any price, but they explain why some businesses sustain high returns on capital for decades, while others lose their edge within a few years. Consider Apple. Its moat isn't just the iPhone, it's the ecosystem built around it. Switching from iPhone to Android means losing access to iMessage, AirDrop, and apps purchased over years. Based on the numbers, Apple's services segment, built on this lock-in, has grown into a significant share of total revenue. That segment carries higher margins than hardware. The brand also functions as an intangible asset. Historically, Apple has maintained gross margins above 40% for years, even as competitors sell similar hardware specifications at lower prices. That gap is evidence of a structural advantage, not just marketing. How do you check for a moat yourself? Start with return on invested capital, ROIC, over 10 years. Look for consistency, not a single high year. Compare gross margins against direct competitors. A persistent gap often signals pricing power. Check market share trends. A moat should show stable or growing share, not erosion. Read the competitive risk section in annual filings. Companies often disclose what threatens their position. Finally, ask whether a competitor with unlimited capital could replicate the business in 5 years. If the answer is no, that's a sign of a real moat. The most common mistake is confusing brand recognition with a moat. A well-known name doesn't always translate into pricing power. Another mistake is assuming a moat is permanent. Kodak and Blockbuster both held dominant positions before new technology made their advantages irrelevant. Moats can erode, so investors should retest the moat periodically, not assume it forever. A third mistake is paying any price for a moat. Historically, Even wide moat companies have produced poor returns when purchased at excessive valuations. A moat protects the business. It doesn't protect an overpriced purchase. Let's apply the framework directly. Here's how Apple scores on the 5 signal score factors. Business quality, 9 out of 10. A multi-layered moat, ecosystem switching costs, brand strength, and a services segment with structurally higher margins than hardware. Valuation, 5 out of 10. Shares have historically traded at a premium to the broader market and to Apple's own long-term average earnings multiple, leaving a limited margin of safety. Momentum, 6 out of 10. Hardware unit growth has been modest in recent periods, while services revenue has continued to expand at a faster rate. Risk, 7 out of 10. Low balance sheet risk and diversified revenue, offset by ongoing regulatory scrutiny of App Store practices in multiple regions. Sentiment, 6 out of 10. Analyst sentiment has been mixed, reflecting questions about the pace of Apple's artificial intelligence product roadmap. Total signal score, 33. 50. Apple shows a wide, durable moat, but its current valuation leaves a narrow margin of safety for new positions. Retail. Investors often treat moat-quality companies as exempt from valuation discipline. The data shows that even Apple stock has gone through multi-year periods of flat returns when bought at high valuations. A second mistake is ignoring the sentiment and momentum factors entirely. A wide moat can offset weak near-term momentum, but it cannot make a stock immune to multi-year drawdowns. A third mistake is stopping research once a moat is identified. Historically, moats have eroded slowly, then suddenly. Rechecking the moat at least once a year is part of disciplined analysis, not optional. A moat protects profits, not stock prices. The price you pay still determines your return. If you want to see the full signal score on Apple, it drops Friday. Subscribe and turn on notifications.